So 3 days ago, I released a video on YouTube talking about Gamestop, and I advise retail traders and investors to stay away from this stock because it was being artificially driven up by a group of traders from Reddit. I think it's like 3 million people creating artificial demand and driving the price up to unsustainable, overvalued levels. And I said it's only a matter of time that the price is going to collapse back down to where it was. So I said stay away from the stock. You're going to get killed if you buy at those levels. At the same time, I also said that I wouldn't short the stock because, again, in the short term, all price movement is manipulated. So even something expensive could become even more expensive. It could go to 500,000. You never know, right? So whether you trade short or you trade long, you're probably going to get killed on this stock. There's a high chance you're going to lose a lot of money. So why in the world did I take a trade on GameStop yesterday? Am I crazy? Yes. No, I'm not. Maybe not. I'm still not sure. I'm going to share with you a trade I took. And the reason I took this trade is because I think that it is relatively a pretty safe trade with a very high probability of success. And whenever I see asymmetrical trades, which means I risk very little to make a lot of money, heck, I'll go take the trade. Now, to be fair, it wasn't my idea. I did not come up with this trade idea. This idea actually came up from one of my students in my trading community. So what's really great about having a big community is sometimes you get the best ideas from other traders or even your students. And I've got no shame in stealing an idea from a student and making money myself, right? Why not? So I'm here to share with you this trade that my student kind of like found by accident, and I thought it's a pretty good trade. I decided to place a small trade on GameStop yesterday, and this is the trade. So first, let's take a look at the price action of GameStop. So GameStop was initially trading at about $20 before it started being pushed up by the gang on Reddit, right? Kudos to them. They screwed the hedge funds, right? Anyway, so they pushed it up from $20 to, whoa, all the way to $483, okay? So again, remember that in the short term, prices can be manipulated up or down, but in the long run, price will always come back down to its intrinsic value. It will always come back down to the value of the underlying business. So I said at that price, you know what, it's gonna drop. I don't know when, but it started dropping, obviously, thanks to Robinhood, right? And so it's down from 483 down to $90. So that's a pretty big drop, okay? Now, how far do I think it's gonna drop to? Again, we can't predict the future, but I think that you'll probably go back down to between $20 to about probably $30. That's my guess, right? $20 to $30 would be a fair valuation for this stock. So it's going to go back down to that level the way I see it. Now, it may or may not, but that's kind of like my guess, right? So what's my trade? Here's my trade. Now, one of the things that I noticed is that, first of all, the stock is oversold. Now, having said that, it can get even more oversold, but the point is pretty oversold right now, okay, based on the Williams R. And what's interesting is if you look at this implied volatility rank indicator, this is our own proprietary software at Piranha Profits, the implied volatility rank is 73. That is insane. Now, what the heck does implied volatility rank mean? It means that the options on this stock is extremely expensive, right? Now, usually the implied volatility is like 30 or 20. This is 73, which means options are really expensive. Now, if options are really expensive, I don't want to buy options. I want to sell options to get a lot of premium. But selling options can be risky. So is there a way to do it in a safer way? Okay, so this is the plan, or this was the plan, right? So what I did was I said, okay, let's take a look at what the options are trading at. So click on trade, boom, all right? And I'm gonna choose an expiry date. So I happen to choose the 5th of March. So these options expire in 31 days. So I'm gonna open up these options, boom. and I'm going to look at selling put options. Okay, so I can choose whatever strike price that I want. 20, 21, 22, blah, 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 right? It's all these strike prices. So I'm going to choose the lowest strike price. And the lowest strike price available is $20. The strike price at $20 is the lowest one available, right? So if I sell this put option at 20 strike price, how much premium do I collect? You can see that right now I will collect about $2.74. So what does it mean? Now, when you sell a contract of options, one contract is equal to 100 shares. So by selling one contract, I'm gonna earn $2.74 times 100. So I'm gonna make $274 per contract. Now, when you sell a put option, you are obligated to buy the shares. You're obligated to buy 100 shares if the price of the stock stays below the strike price by the expiration date. The expiration date is the 5th of March. So again, right now, Gamestop is at $90, right? I have got 31 days. So in 31 days, on the 5th of March, if GameStop stays above the 5th of March, in other words, it expires above the 5th of March, this option I sold will be worthless. It'll be worthless and I get to keep $274. So that's kind of like free money, right? But what happens if GameStop goes and stays below $20 by the 5th of March? If that happens, then I'll be obligated to buy 100 shares at $20. Okay, so if I buy 100 shares at $20, how much is it going to cost me? It's going to cost me $2,000 per contract. But remember that I already collected $2.74 in premium. So $20 minus $2.74 is $17.26, which means that effectively I would be buying GameStop shares at $17.26 times 100. I'll be paying out $1,726. The question I have to ask myself is this: if this happens, if GameStop really stays below $20 by the 5th of March, am I willing to buy 100 shares at $17.26? The answer is, I don't mind doing that. Why? Because although GameStop is not a great company, in fact, GameStop is still losing money, but they are looking to turn it around. Although GameStop is not, a high growth company yet, but I think that if I were to own it at $17, it is gonna be undervalued. All right, so I don't think it's that bad a deal if I end up owning it at $17. So what do I think GameStop shares are worth? GameStop shares are very hard to value because they are currently losing money and currently the cash flow is negative. So I can't use PE ratio to value the shares. I can't use a discounted cash flow method. I can't use a discounted profit method. So how do I value GameStop shares? How do I know what it's worth? So one way to value it is to look at the price to sales ratio. Okay, the price to sales ratio. So I have to compare GameStop with other companies similar to GameStop. So I did a bit of research on Zacks Research. And let me just show you what I found on Zacks Research. There we are, okay. So on Zacks Research, you can see that its competitors are some of these other retailers. Some of them are losing money as well. And if you look at all the companies in that same industry like GameStop, their price to sales ratio, median, okay, is 0.32. Price to sales ratio is 0.32. Look at that figure, 0.32, okay? And currently, if you look at GameStop's revenue, its revenue per share is $79.32. So for every one share of GameStop, it is generating $79 in revenue. Again, we can't use PE ratio because there's no profits. So we have to use revenue to estimate the value of the shares, right? So if the revenue per share is $79.32, we multiply that by 0.32. Because remember, the average price to sales ratio is 0.32 for a company in the industry, right? So 79.32, let me write this down. 79.32 times 0.32 equals $25. Ta-da! Oh. So what does that mean? That means that the intrinsic value of GameStop is about $25. That's what it's worth right now. It could be worth more in the future if it makes profits, but right now it's worth $25. So if it's worth $25 and I'm owning it for $17, that's okay, right? That's kind of like getting a 30% discount to the shares anyway. And this is the worst case scenario if I end up owning the shares. Chances are, if GameStop doesn't go below $20 and stay there by expiry, I don't have to buy the shares anyway, and I just keep $274 per contract. So let me summarize the outcome of this trade. What are the potential outcomes? So scenario number one is that GameStop stays above $20 by the expiration date on the 5th of March in 31 days. If it stays above $20, the option I sold will expire worthless and I'll keep $274 per contract, which I sold. Now, $274 divided by $2,000, which is the capital required to place the trade, will be equal to about 13.7% ROI in 30 days. So making 13% in 30 days. If you analyze it, that's 13% times 12. That's kind of like 156% return a year. Okay, if you analyze it. Now that's scenario number one. Now, what is the probability of GameStop staying above $20? Now, right now, GameStop is at $90. So even if GameStop drops another 70%, it will still be above $20. So I still have a 70% drop buffer, right? Now, if you take a look at the option, you can see this thing called delta. The delta of the 20 strike is 0.04 delta. Now, what the heck does that mean? 0.04 delta means there's only a 4% chance that the stock price will stay below $20 by 5th of March. Only a 4% chance. Which means the chance of me getting this scenario would be 96%. So I've got a 96% chance of getting this money for free. Okay? Now, the second scenario would be a 4% chance. There's a 4% chance that GameStop is going to go below $20 and stay there by the expiry. If that happens, I will be obligated to buy 100 shares at $20 less the premium collected. I would end up paying $17.26 for 100 shares. So I'll end up buying 100 shares times $17. So I gotta have 1726 in cash ready to buy the shares. We call this a cash secured put. Never sell a put naked without having the cash to own the shares. You must have the cash ready to own the shares, right? So again, in scenario number 2, with a 4% chance, worst case scenario, if I own the shares at $17, is it okay? I think it's okay because like I showed you, I think the intrinsic value of the shares are $25. So even if I buy it at 17 bucks, that's like a 30% discount to valuation, although it's not a great business, although it's not profitable yet. But hey, you know what? The worst I can do is to break even on this trade. So 96% chance of making 150% return a year and a 4% chance of breaking even. Not a bad trade, asymmetrical reward, and that's why I took this trade. So I entered this trade on 2 accounts, and it's a relatively small trade. So the first one was on this account. You can see that's my GME. Let me make it a bit bigger. There you go. So I sold the GME put at a 20 strike expiring 5th of March, and this one filled at $2.72, right? And you can see over here my portfolio. It's over here. Let me see, where's A, B, C, D, E, F, G. Yep. So Gamestop, there we are, 272. Right now, the price has gone up slightly to 274. So if I were to buy the put back, I'll lose like 12 bucks. I'm not going to do that, right? I'm not going to buy the put back. I'm just going to leave the put to expire. Whether is it in the money or out of the money, doesn't matter. Out of the money, I don't get the shares, but I keep the full premium, right? So I sold 6 contracts at 272, so I collected about $1,600. Again, it's a very small trade. I may add more to this position later on, tomorrow. We'll see how it goes. But for now, I started with a small position on this, right? And again, like I said, if the price goes below $20 by the 5th of March expiry, then I'll be obligated to buy 600 shares at $20, right? Minus 272, I'm paying like $17 per share, which I don't mind owning the share because I think that, you know, there could be some potential upside if the turnaround, which they're doing right now, succeeds. If it doesn't succeed, I'll just sell it at break even, right? But if GameStop stays above $20 in 30 days, I keep this $1,600 for free. All right, it's like free money, free premium. I took this trade as well on another account, which I have over here, right? So this one I got in a bit earlier, so I had a slightly better price over here. GameStop, you can see I sold 3 contracts at 276. So this I got a better deal at 276, and you know, price went down a bit. So this one I just have $3 unrealized profit. But again, when this put expires, I'll collect about $800 on this trade. So we'll see how it goes. I may add more to this position because I think it's, again, an interesting trade. So wish me luck on this trade. And let me just end off by saying that this is not a recommendation to put on this trade. This is purely shared for educational and entertainment purposes only. And you should never trade options unless you're properly trained in options trading, because options are kind of like a nuclear weapon. If you handle it wrongly, you could blow yourself up, but handled correctly, it can be a very powerful tool to get high returns with low risk with high win rates. This is Adam Khoo. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.